Today we're back on the podcast with another episode on the topic of investing. Now, when it comes to investing, it can be really hard to choose what to invest in, especially because there's probably hundreds, if not thousands, of different choices. Because of this, I'm joined with Andreea and Jamie, founder of Stocks and Savings, to delve into all the different types of investments you can make and how to choose the correct ones. Hi Andreea, hi Jamie, how are you both doing today?
Hi, we're really good.
Yeah.
Thank you. So excited to be here.
I'm very excited because the last time we chatted, we were doing this via Zoom, and now we've got you in the studio, which is fun. We've got the lights, we've got the camera, we've got the action.
I was going to say, I think we were in our shed last time. We did this over there. So this is a lot nicer.
Yeah, no, I love it. Well, thank you for coming onto the podcast today. I guess for those who probably haven't heard of either of you or listened to our previous episodes before, please introduce yourself to everyone listening.
Yeah, so we're Andreea and Jamie. We're two millennial investors and qualified accountants behind the Stocks and Savings channels on Instagram. We have our podcast, the Stocks and Savings podcast, our newsletter, and more recently our YouTube channel as well. So we're basically everywhere. We're just trying to spread free financial education for everyone.
Yeah, no, I love that. And obviously you talk about the topic of investing. What actually encouraged or motivated you guys to start sharing content online?
I feel like a lot of content creators, we started in 2020 during the lockdowns. So it was just us in a tiny London flat. And we just thought we have to do something, otherwise we'll go crazy.
Yeah.
And we both have backgrounds in like finance and maths and economics. So we thought, oh, why don't we just start investing? We had just found out about Trading 212 as well, like a super low fee platform. And we just thought, oh, what could happen? Let's just give it a go.
Yeah.
And then we also decided to document our journey on Instagram, and kind of the rest is history, I guess.
Yeah, and you guys have taken off, haven't you?
Yeah, it just kind of grew from that. Funny enough, it was actually the first post that we ever did that went close to being viral. It was actually about Liz Truss's budget back in, it was either 2021 or 2022, I can't remember.
Yeah.
Seems like a long time ago.
Honestly, well, how many other days of raining the UK? But.
Yeah, exactly. So it was that one thing, and we kind of went from, we built up about 20,000 person following on Instagram over the course of about 18 months. And then that went to about 80,000 a couple of months later, just from these couple of posts. And and it was great, because it just allowed us to get a lot more eyeballs onto everything else we were talking about, and specifically learning about investing. And it's just, we're very lucky with how it's gone.
Yeah, and actually that's what kind of happens in investing as well. Like for a long time, your investments might not do anything. Mm-hmm. And then at some point they would go up a bit. The next day they might go down by a bit. But over time, generally, over long periods of time, investments tend to go up. The stock market tends to go up due to technological progress, due to demographics, like economics and all of that.
Yeah, that's a really good analogy, to be fair.
I was going to say, this is also our life now. Anything can be tied back to an investing analogy.
It's terrible. When we do any sort of spending, we're like, no, we're investing in ourselves.
Yes. We have to. I mean,
exactly.
As well as being financially free, we also need to be investing in ourselves as well.
Yeah, and we also need to be happy, right?
Yes.
Yeah.
Like, what's the point in, having all this money and then being miserable?
No, exactly. It's so true.
Look at Elon Musk.
Yeah. Oh gosh, let's not even talk about him.
Maybe we won't include that. But just because obviously he's been divorced a few times, he can't be, can't have the best personal life in the world.
Yeah,
probably.
no, literally. Maybe he's crying himself to sleep. I don't know. But I guess to warm you guys into the hot seats today, I had 2 quick fire questions before we delve into the topic of investing. So, coming at you, Andreea, first, what's been your greatest financial achievement? Or you might have the same.
We might actually, just because.
I changed mine. We thought about this a little bit in advance, and you don't. I don't think you know what I'm going to say.
Oh, okay. Well, there you go.
So we don't have the same one.
Perfect. Well, I think it's going to sound a bit cheesy, but probably building Stocks and Savings.
Okay.
And it's probably more of an impact sort of achievement rather than financial. I mean, we're very lucky that we're able to earn good money from doing what we like to do. But just, being able to speak to people and hearing their feedback and say oh, you've helped me so much with this or that. It's actually really fulfilling.
Yeah.
And I went from working a corporate job to doing this, from kind of being a cog in the machine, I suppose,
yes,
to actually having a direct impact on people's lives.
Whilst making money.
Yeah. So that's kind
That's
of
a
amazing.
dream, isn't it, I guess?
Yeah.
I don't know how long this will last for. Probably not forever.
No,
you know,
but you'd like to think,
we'll
especially
see.
with the different channels you've made, the multiple streams of income you've made, which is what I always hammer on to everyone listening to the podcast about the importance of different streams of income. Jamie, would you agree with that being your greatest financial achievement as well?
So that was initially like the first thing that came to mind. But I think since we're talking about investing, I'll bring it back to something that was a bit more on my investing journey. And as Andrea said earlier, we started investing in 2020 when lots of people did. And what we actually saw in the stock market in 2020 and 2021 was a lot of excitement,
Yes.
a lot of euphoria, particularly in different pockets of the stock market. You know, you saw certain investments that were rising to beyond levels that they should have been.
Yeah.
And, you know, a lot of these were like fast-growing tech stocks, companies that benefited from the pandemic. And, yeah, we invested in quite a few of them. I think we might get onto some of our mistakes a bit later. But that was a mistake. And they were getting more and more expensive. And in 2022, inflation hit and interest rates rose. And a lot of these investments just came tumbling.
Oh, wow.
I mean, we saw at its worst, it was either sometime between mid 2022 and 2023. Like at its worst, our portfolios were cut in half, and we'd been documenting everything online.
Yeah.
We put a decent chunk of money into it, and it would have been so easy to just kind of get scared out of investing at that point. To have just been like, this is rubbish, you know, it's all a scam, it's awful, it's, you know, all the bad things you ever hear about investing. But and you never really know how you're going to react in that moment when you see yourself losing that much money. And I think one of the things I'm probably most proud of is the fact that I kind of kept going.
Yes.
You know, I learned from a decent number of the mistakes that I made.
Yeah.
But I think there were a few things I did right too. And I tried to learn from that, keep going, and fast forward to today, I think my portfolio is probably up by about 30%-ish.
Wow.
I think it might be a bit more. And that's from being cut in half to now making quite a comfortable profit. I say that's probably beyond this business. When it comes to investing, I think just not giving up and staying consistent and staying true to everything we were talking about beforehand. Like, if it crashes, we are going to keep investing.
Yep.
That's probably my biggest achievement, I'd say, financially.
Your portfolio has probably like almost tripled, right? From like
from that point, probably. Yeah.
Which is kind of crazy.
It still surprises me to this day how quick the recovery has been. But that is just why it's important. When you invest, you need to do it with a long-term mindset.
Yes.
And you need to know that probably the one thing that I can guarantee anyone listening is your investments are going to fall at some point.
100%.
Like that's the most important thing to remember.
Hopefully not by 50%.
Hopefully not. Hopefully not by.
That's not the plan.
Yeah. If they fall by 50% and the broader market's fallen by like 10 or 20%, then maybe you need to have a look at what you're doing, because that's what we did.
Yeah.
But you know, the market can fall by 30, 40, 50% during really bad times. And it's just knowing that your investments will fall at some point, so just try not to get freaked out by it.
Yeah. No, I agree. And I guess my second question to both of you is, if you won the lottery, what would you spend the money on?
Well, at the minute, I think we're looking more and more at like nice houses.
Okay.
And we're realizing how out of budget they are.
Yeah.
So that would probably be first on my list, like a nice house, you know, with a few rooms, like enough for us, and like, I don't know, a study or something, maybe for kids one day.
Yeah,
Who
one
knows?
day.
Room for a dog.
Yeah,
most
and maybe
importantly.
even in London, because we used to live in London, but we had to move out if we wanted to afford any houses. So we now live around London.
Okay.
But I would like to go back one day.
Yeah.
I do miss it.
Yeah, I can imagine.
So yeah, I think that would probably be
Number
kind
one.
of like,
Yeah.
the top on my list.
Jamie?
Yeah, I think so. Definitely a house in like one of the areas of London that is so stupidly expensive that no one can live there. Kind of like, I don't know, Sloane Square, Kensington area, somewhere nice to the
Just off
centre
of
with a
Oxford
nice.
Circus or something.
Yeah, exactly. Like, you know, one of those places where I don't even want to know how expensive the houses are. I think that's definitely one thing. And the other is just, I think you hear a lot of the money can't buy happiness. I kind of agree with that, but I think it can buy a lot of comfort.
Oh, yeah.
And a lot of ease.
Yes.
So I think that is probably the one thing I would do is, right, how can I use this to make my life easier? To take away from all these annoying little things that stress me out. Like, we've been having such a nightmare with our boiler over the last week or two.
It all goes
And
back
it's not the time for
No.
having issues with your boiler.
No, not at all. So rather than having to worry about it, I can just get a brand new boiler, which is going to run fine for years. Stupid little things like that.
Yeah.
I would use it to just make life a bit easier. And then I think it's just nice to have the freedom to not have to earn money.
Yes.
And you can actually, spend your life doing whatever you want to do. I've always, it's a bit cheesy, I've always said that, like, if something like that happened, because we've spoken about, like, financial independence before, the ability to do whatever we want, because we're able to do so because we have the money saved up in investments and whatnot. One thing I'd always like to be able to do, if things went really well, was open my own rescue dog shelter.
Oh, wow.
So I'd love to spend my days doing that.
That would be
so that's what it would be.
I love that. I actually love both of those answers. Yeah, I'd be like, number one is buy my own property. Second, maybe pay off my mum's mortgage. I'd love to be able to do that as well. So yeah, I've definitely got a long list. So maybe I should start doing scratch house so I actually have a chance of winning. But obviously we're chatting about investing today, and both of you touched on the fact that you have both started investing back in 2020. But what were your reasons for investing in the stock market?
So we actually started investing at the start of 2020, just before the pandemic. And I think we started seeing apps like Train 212 and Free Trade crop up, which for the first time in what felt like ever, it meant people could invest. And even if they didn't have that much to invest, I mean, our first investment was £50.
Yes, I love that. I'm glad you shared that, actually.
Yeah, well, I think it's important. It's important to point out that, and this is what those kind of apps changed, is that you don't need to be rich in order to start investing. They really did democratize it, and so it gave us access to investing in whatever stocks we wanted, because if it weren't for those kind of platforms, we'd be paying pretty egregious fees.
Yes.
And so we started a little bit before the pandemic, but then lockdowns hit. We found ourselves both with pretty well-paid jobs, but that we were able to do remotely, but our expenses just disappeared, or at least a lot of them did. And so we're like, okay, we've got all this time, we're trapped indoors, we have more money than we did before. Let's, and obviously we have our backgrounds in maths and finance, and we were both, I think, doing our accountancy qualification.
Yes.
So we were like, let's properly learn about investing. And it's been a journey.
Yes, always is.
Yeah, exactly. Like, we're completely different now. Our priorities are completely different now. The way we view what we want to get out of investing is completely different now. But yeah, that's kind of how we started, and not really looked back.
Yeah, I think at first we had very different views of investing compared to what we think of investing now.
Yeah.
At first we were all about, let's just make a quick profit. Let's just buy this, sell this tomorrow, try to make 5% on it or something like that. Whereas now we're very much in it for the long term. Or at least my approach right now is mainly buying index funds, which basically track the performance of the stock market over time. So I just want to be able to profit from that, from the technological progress that happens, from companies doing better and better. And I want to be a part of that. I don't necessarily want to try to beat the market or try to make a quick profit anymore.
Yeah. And you know what I love the most about that you did it as a couple, because I feel like there's so many couples out there where it's just the male counterpart investing in the stock market, and they've left their female counterpart behind. So the fact that you both decided together as a joint effort, learn about the investing in the stock market, how to actually go about it, and then also probably change your strategies, like you said, from the day one. But Andrea, you mentioned ETFs, which is obviously one form of investment people can make. So those listening to the podcast, if they wanted to kickstart their investing journey, what are the different types of investments that people can make?
So there are stocks which represent ownership of a company. If you buy a share of a stock, then you become part owner of that company, which means that you have a claim on the company's future earnings.
Okay.
But then there are also ETFs, also known as exchange traded funds, that basically have lots of different stocks within them. So by buying a share of that ETF, you would be buying a share of multiple companies, say, I don't know, Apple or like Microsoft, Google, stuff like that. And that means that you're not putting your eggs into like one basket.
Yes.
You get to spread your risk. And if one company does really well, maybe one doesn't. So you get somewhere like a return that's somewhere in between all of those. But it also means crucially that your portfolio probably won't experience really sharp fluctuations.
Yes.
Which is good.
Yeah. And that's what we want. We don't want like, I don't know, 90% today, 2% tomorrow because someone's tweeted something on Twitter or something. Yeah. Do you know what I mean? And I'm not even going to go into the different companies and CEOs that have caused those things to happen in said companies. But I think that's really important. And are there any other type of investments that people can make outside of ETFs and shares as well?
So, I mean, even within the world of just stocks alone, there's such a broad range of investments. But outside of that, there's bonds, which are basically a lot safer. They're closer to savings, kind of like savings accounts. Not quite, a little bit more risk. You've got commodities, so things like gold, silver, copper, I don't know, lithium, stuff like that. You've got real estate as well. You can invest in collectibles, Pokemon cards. If someone really twists my arm, I'll throw crypto in there as well. Yes. But that one's not for me. Okay. There's just so many different ways that you can try and make your money work for you. The reason that we've gone more down the investing in stocks route is because one, we feel like we can understand a lot more what drives the value of it. Unlike, for example, maybe something like gold or crypto or Pokemon cards.
Yes.
And then it's also, it can be, if you take that approach of investing in like a broadly diversified ETF with thousands of companies from around the world, it can be a really hands-off approach.
Yes.
Unlike something like real estate. I mean, I was complaining about our boiler earlier. Like, I have enough problems with my own house. I don't want to look after another one.
Yeah, I feel you. No, thank you so much for breaking those different investments down because, like I said, I feel like people get really overwhelmed by the thought of how many investments exist. Now, obviously, you guys have been investing for nearly 5 years now. Gosh, time flies.
Right.
So for those listening that have probably heard the different types of investments, how can people choose the right investments?
So the right investment for you is going to differ from the right investment for me. It's going to differ for the right investment for Andrea. I mean, even just the two of us, we started both investing a lot in these kind of like fast-growing, like high-flying individual stocks. That was a mistake.
Yeah.
But now, as you say, I can't believe it's been almost 5 years now, and we've kind of figured out a lot more what works for us. So I am probably still more comfortable and more interested in having a lot of individual stocks, or like having individual stocks as the majority of my portfolio. But you kind of realize that actually you prefer having a global index fund, which is just a very hands-off fund that invests in thousands of companies across the world, as like the bedrock of your portfolio. And I think for a lot of people starting to invest, the way that we did it was completely in reverse. We started with riskier individual stocks, and then we moved on to the safer investments.
Yes.
I think for a lot of people, just start with the safer investments. You probably have years, if not decades ahead of you to invest. Don't scare yourself out of the market by investing in the risky stuff first. If there's an exciting opportunity this year, there will be another exciting opportunity next year, and there'll be another one the year after. So just give yourself that time to learn, and build a stable foundation to your portfolio before you decide to go on, to go and do more exciting things.
Yeah. Andreea?
I would say that if you're interested in long-term growth of your money, stocks are probably the best way to go about it, but over the long term. So at least 5 years, but ideally decades.
Yeah.
And exchange-traded funds or index funds, for example, are usually the best way to go with that. So as Jamie said, my preferred investment is a global index fund that just tracks thousands of companies' performance all over the world. And that means that I'm not putting my money into just one company, but not even into just one country. And the great thing about a global index fund is that it adjusts the weighting to each stock and country over time. So for example, Japan was 45% of the value of the global stock market at the end of the 1980s, which is crazy.
That is crazy. I didn't know that.
Well, fast forward to today, it's only about 6%.
Wow.
Yep.
Yeah. So if you had put all your money in Japanese stocks, it wouldn't have done very well.
Yeah.
But if you had bought a global index fund, your portfolio would have done very well over these past 30, 40 years. And it's the same reason why I don't have all my investments in US stocks, because the US now makes up about 60% of the global stock market.
Yeah.
And don't get me wrong, I think it will probably still do very well. But I just like having that peace of mind that I don't depend on only one country. And I might be shooting myself in the foot because I feel like I'll get a lower return than if I had just invested in the S&P 500, which is the leading US index. But it's worth it for me, having that peace of mind.
Yeah. And I think what you mentioned, Jamie, is really important, is what works for you might not work for me, and what works for me might not work for Andreea. So I think it's like you mentioned, picking something that you're comfortable with, choosing that desired level of risk. And I guess, speaking of risk, for those that probably want to invest but are too scared to pick those investments, there's platforms out that help people do that, don't they?
Exactly, yeah. There are platforms where you can just answer a bunch of questions and kind of choose a risk profile. It usually goes from cautious to balanced to adventurous.
Yes.
And then the platform does all the work for you. You'll have to pay a higher fee than if you were to choose your own investments. But likewise, it's better than not investing at all.
Yes.
So,
yes. Yeah. And I agree. And I guess, obviously, like you mentioned, Jamie, you've got more stocks. Andreea, you've got ETFs. What are the different types of ETFs? Because I guess, and I'm not going to tell you to break down every single one across the stock market, but just some examples. Guys, if you're listening, this is not investment advice, but I think it's really important for people to be aware of the different types that exist, because I think it's all good and well for us to say ETFs, and then they open Vanguard, and then you see VMID 500 or 5,000 or, I don't know, cumulative or distributing. So it's very confusing. So what are some key words people should be looking for?
Yeah, they don't make it easy, do
No.
they? It's like learning a different language.
Yeah, exactly. It's almost like it's intentional,
I think
to keep us normal people from understanding all these things.
Raising that barrier to entry, personally, I think.
So I'll tell you what I'm going to do. I'm going to open up the investment platform Train212, which is the one that I use, and I'm just going to go through the global index fund that is the top fund or the top holding in my portfolio. So I'll still kind of sensible, still have it now as my largest individual holding.
Yeah.
And just kind of break it down a bit.
Character development right there.
So it's called the Invesco FTSE All World, and it has AC in brackets after it, and it has a ticker symbol which is FWRG. So if that does sound like a load of nonsense, it is. You look at that and you think, what on earth does that mean? So you can just break it down into separate parts. So these funds will start with the name of the fund provider. In this case, it's Invesco.
Okay.
And they are just the company that puts together this ETF for you to invest in.
Amazing.
And then next up, we have FTSE All World. Now, that is just what's known as a stock market index. And I think we've said index funds a few times already on this podcast. So a stock market index, it's basically just a list of companies from a certain sector of the stock market, and the index just measures the performance of those groups of companies, or of that group of companies. So, for example, you mentioned the S&P 500 earlier. That's just a list, of 500 medium and large companies in the United States. In the S&P 500 index, the purpose of that is just to measure how they're performing. But studies showed that actually these indexes tend to perform quite well.
Yeah.
So some funds and some fund creators, like Invesco in this case, will look at an index and basically just copy it and invest in the same companies in the same proportion. So this one, the index is the FTSE All-World Index, which is one we've mentioned. It contains thousands of companies from all across the globe.
Okay.
So the next part here, it says AC in brackets, which is probably the most confusing looking thing. That's just short for accumulating. Now, the other thing you might see is DIST, which means distributing. And this is just in relation to the dividends within this fund. So as you imagine, this fund invests in thousands of companies. Some of these companies will pay dividends, which are basically cash payments that companies can choose to make to their shareholders every 3 months or 6 months or a year. Not all companies do, but a decent chunk of companies do choose to pay that out as a way to say thank you and share their profits with investors. And AC, or accumulating, basically means that any dividends received from these thousands of companies, Invesco will keep that money in the fund and automatically reinvest it. So it will boost your returns that way. Whereas if you saw DIST, it means they would pay it out as cash and you would have it in your portfolio and you can choose what to do with it. When it comes to long-term growth, reinvesting dividends is a great way to supercharge your returns.
Yes.
But I prefer the accumulating one because, well, it does that for me.
Yes.
And the final thing is the FWRG, the random bunch of letters, which you will see with pretty much anything. And that's just known as a ticker symbol. It's simply a unique code used to identify this particular ETF. You know, stocks have it as well. And it's just a way of, picking out this ETF or stock in a world full of different stocks. So, hopefully that breaks it down a little bit in terms of things to look for when it comes to these funds and ETFs.
Yeah, no, thank you so much, Jamie, because I think you explained that perfectly. Because like I mentioned, there are so many different words. Like I said, we'll probably hear FTSE World Cap today, and then someone will look at the platform and it will say a whole another thing. So thank you very much, Jamie, because I don't think I would have been able to explain it as well as you did. So I appreciate that. And I guess, like you mentioned, you both use Trading 212 to invest in your portfolio. For those looking to start investing or beginner investors, what are the best platforms out there, or how can people find the best platform for themselves?
Yeah, I think, to be honest, there are so many good options in the UK. We're really spoiled for choice now. There are obviously the newer platforms like Trading 212 and probably Invest Engine.
Yes.
You have Dawdle by AJ Bell, I think. These are really good. They're app-based and they have very low fees.
Yes.
Which is great because it basically means that you get to keep more of your money, which is always nice.
Yeah.
But likewise, these companies are able to have such low fees because they probably invest less money into customer service. They might just have online web support, and not everyone might be comfortable with that. So, there are other platforms, for example, Hargreaves Lansdowne.
Yes.
I think everyone and their
Everyone
mom.
knows them. And dads.
And dads.
I think everyone's dad uses Hargreaves Lansdowne.
Yeah, classic.
Yeah, exactly. And, they have higher fees, but likewise, you can probably speak to someone on the phone and get more support. So you can use that as well. Stuff like AJ Bell, Interactive Investor.
Yes.
There's really no right or wrong. And like you mentioned, managed platforms like Moneybox, you have Nutmeg, I think it's a really popular one, Wealthify.
Yes.
So we're really spoiled for choice. I think my approach would probably be to go for a low cost and see how I get on with that. Maybe go with a global index fund as the foundation of my portfolio. And then you can look at more exciting things like individual stocks after that, or maybe commodities, stuff like gold, maybe even some crypto. Who knows?
Yeah.
But I would say get your portfolio in a solid kind of place where you don't take too much risk, but you're also poised for long-term growth with a global index fund. Obviously, not financial advice, but that's probably a good starting point for most people.
Yeah.
And I think you mentioned as well, you listed out all those platforms. And you're right, we are absolutely spoiled for choice. One of the only problems with that is, and I think it's the same with a lot of things in the world of investing, I think you can hear that and be like, so what do I pick? Because there are too many out there.
Yeah.
And I think what's really important to know is that you can change between platforms.
Yes.
You can start on one and be like, oh, wait, this is a managed platform. I want to find individual stocks, or vice versa. Or actually, I don't need too much, great customer support. I'd rather have low fees. You're not tied into that one platform for life. So it's very easy to get into like an analysis paralysis with this kind of stuff. So I think we always say that just starting is better than starting perfectly.
Yeah.
Look at how we started. You couldn't start much worse than we started in terms of our investing journeys, and it's gone okay from then on. So just start small, get confident. You're gonna figure out what you want along the way.
You can even use multiple platforms. You can test out multiple platforms, because you can now have stocks and shares ISAs with multiple platforms and use them within the same year. Whereas before April 2024, you couldn't do that. You had to stick to one stocks and shares ISA each year. But the government have simplified that and have also made partial transfers of stocks and shares ISAs possible. So you can just choose, for example, I have a 90K portfolio on Train 212. I could just take 10K of that and put it, I don't know, in some other place, Vanguard, for example.
That's so interesting, because I didn't actually know that. And this is why, guys, I always have guests, because I'm always learning something new myself. And like you said, Jamie, don't overthink yourself out of investing because you want to be perfect. Like, there's no such thing as the perfect way to start investing. I think you have to try it, see how you get on. If you don't like it, then you can always readjust. So I think that's really, really important. And I guess to round up today's podcast episode, what are 3 final tips you would share with anyone listening or watching the podcast to kickstart their investing journey?
Well, one thing that I wanted to add so this is perfect, is to use a tax-advantaged account when you start investing.
Yes.
So something like a stocks and shares ISA that I just mentioned, or a pension, also called self-invested personal pension. It's really, really important, because even if you're starting small and you might not have to pay tax on any gains now, hopefully you'll be able to build out that portfolio where at some point it will be liable for tax. So it's really important to start within a tax-efficient account. So a stocks and shares ISA is basically an account where you can invest up to £20,000 a year.
Yeah.
And any gains or dividends that you make from that are not taxable, which is great, because obviously you get to keep more of your money, but also you don't have to complete a self-assessment tax return, because that's a nightmare.
Yeah, I know.
We're self-employed, right?
So hate it.
Exactly. So, save yourself some trouble and just use a stocks and shares ISA or a pension to invest.
Love that. Great tip. Jamie?
I think probably the biggest thing that we've learned, both from the business that we've launched and also from our own investing journeys, is just consistency. Make sure that whatever you're doing is something that you can and you feel like you'll be able to do. For example, investing, whatever it is, £20, £50 every single month. Just make sure you say to yourself, right, I am going to do this. I don't care if times get hard. I don't care if I make mistakes. I'm going to keep going. I'm going to learn. And hey, as I get more confident, maybe I can, or as I get, more money, if I get a raise at work, then maybe I can start increasing the amount that I'm putting, into my investments. But I think just consistency is key, because if you're not consistent, and this happens with so many people, I think there's a lot more education out there nowadays, which means it's happening less, which is great. But I think so many people, they'll start investing when they're hearing about the stock market. And a lot of the time when you're hearing about the stock market, it's when there's a lot of excitement in the stock market.
Yes. Or something really bad.
Or something really bad, in which case people will tell you to run a mile.
Yeah.
So neither of those places are ideal times to start if you're just going to lump in an investment today and just be like, see how that goes. So just consistency, because we started investing at a very bad time. We made a lot of mistakes, and it really was not fun for us for a period of time. I think we spent 18 months of our portfolios making a loss.
Wow.
So that's a year and a half of opening up our portfolios and seeing ourselves losing money. And it's just consistency that got us where we are today. It's just continuing to top up every single month when we got paid. And that is it. There isn't, There doesn't need to be any kind of magic. There doesn't need to be anything particularly smart about it.
Yeah.
It's just consistency.
Yeah, I love that. And Andrea, final tip to round off?
Ooh, final one. Should be a good one, huh? Well, I would say one of the mistakes that I made when I started was that I was playing someone else's game. So I started looking at other people who I thought were successful investors, and they were.
Yeah.
And I started copying their investments with no regard for whether those investments align with my risk tolerance, with my goals, with my timelines, or anything like that. And it was a recipe for disaster.
Yeah.
Basically. Because when those investments started falling, I just didn't have any sort of confidence in them. And I started selling, and that just ended up in a loss. And it was just a mess. So I would say kind of do some soul searching, just figure out what you're comfortable with. You can do it through trial and error, maybe just with small amounts at first, and find an approach that works for you. Don't copy your mate. Don't copy us.
Yes.
Just find what works for you.
Yeah. No, I love that. I think that was the perfect way to round off because, like I've always said, people always want to know how to invest, but get too scared or get overwhelmed when the minute they actually are told to go start. So I think you two are the perfect people to have on the podcast today to delve into different types of investments and how people can get started if you aren't already investing yet, guys, although you definitely should be. But you guys create great content online. You've got Instagram, TikTok, YouTube, podcast, newsletter, you've got everything. So if anyone wanted to find you guys, where can they go to do so?
I mean, you can go on Instagram, search stocks and savings. You can go on YouTube, search stocks and savings. I hope I've got our SEO right. You can go wherever you get your podcasts, as long as it's Spotify, Apple Podcasts, or Amazon Music, because it's easy to distribute there. And hey, why not type stocks and savings into Google? You probably see our website as well. So
Perfect.
we try and be
we're
we
probably
are
doing too much, but
I think so. But
we just want to spread our financial education as far and wide as possible, so that everyone can benefit from it.
Yeah, and you guys are doing a great job, so thank you so much.
no, thank you. Thanks for having us on.
This was fun.
Yeah, it was.